Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and a few stock picks in one of the most interesting post-pandemic trends I'm watching. According to the Rand Corporation, just 4% of the US population accessed telehealth before the pandemic, with restrictions to telemedicine delivery making it a non-starter. Now, because insurers would only reimburse telemedicine visits under special circumstances, the healthcare industry just never adopted that change in technology. That red tape and the lack of change in healthcare is a big reason why Americans pay 145% more for healthcare than in the average developed countries. We here in the red, white, and blue are paying an average of $10,000 a year for healthcare versus just $4,000 in other OECD countries. But with social distancing and the lockdowns, the industry was forced to relax restrictions on telemedicine delivery and access boomed. A recent study published on the network run by the American Medical Association found telehealth services grew by as much as 4,000% last year, with doctors at UCLA alone doing 2,700 telemedicine visits a day. The technology was able to replace up to 40% of office visits and took access to healthcare to everyone. And even as life gets back to some kind of normal, the benefits of telemedicine have become apparent. Management at the UCLA Health Network expects 20% of their volume to continue to be virtual through those telehealth visits. And this all goes way beyond just those virtual doctor visits. There is a revolution happening in healthcare, from data analytics to IT services and software. Using technology better is saving time, money, and more importantly, bringing access to a large portion of the population that was underserved before. It is that trend I saw when recommending Phreesia Inc. last year at $24 a share. The company is a leader in medical payment solutions for an addressable market of over $7 billion and a huge advantage in that software as a service model. That trend took shares of Phreesia to $79 each, and even after the sell-off in growth stocks, the stock is 102% higher over that year. In this video, I'll show you how to find telemedicine stocks and how to narrow your list to the best in the group. Then I'll reveal 3 telehealth stocks to watch for that revolutionary trend in medical care. We're getting started, but you know I've got to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. To start our list of telemedicine stocks to research, we'll head over to the Stockcard.io and look in the featured collections section. Now, these are groups of stocks and some of the biggest trends and a great place to start. We've got a telemedicine list, so I'll click through there and we see that there are 60 stocks in the theme. Now I'm going to click off on this OTC toggle so we only see stocks traded on the major exchanges, but we'll keep on this penny stocks. I'll show you how to narrow your list later, but you can also add some filters here to screen your stocks. I can select stocks by market cap, so the size of the company. I can filter for good sales growth here and a lot of other fundamentals to start my research. Here we've narrowed the list to 25 companies to research further in that telehealth trend. I'll leave a link to Stockcard in the video description below. Don't forget to click through and follow the 2021 Bowtie Nation portfolio, up 37% already this year and beating the market by 26%. As a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BOWTIENATIONS, all one word in lowercase, for an exclusive discount beyond the free trial. Our first telemedicine stock in the list is Tabula Rasa Healthcare, ticker TRHC, a billion-dollar analytics platform for pharmaceuticals. Now, Tabula Rasa uses a unique data analytics platform to optimize drug regimens and reduce medication risk. Instead of the one-to-one interaction software, its MedWise platform analyzes side effects across all the drugs in a patient's plan. And that's important because the more medications that get added to a patient's plan, we see a huge increase in adverse drug events, along with 1.3 million ER visits a year and over $35 billion in medical costs. The platform is already being used by more than 350 health plans and 15,000 community pharmacies, with one study showing a 43% reduction in drug-related hospitalizations and an ROI as high as 13-to-1 for clients. Sales grew at a 20% annualized pace over the decade through 2019 and are expected to reach $344 million this year. Now, growth is expected to slow a little to around 15%, but the price is good on this one at just 3.2 times sales, and the average analyst target of $57 a share is 32% higher than the current price. We've still got 2 more telemedicine stocks to highlight, but I want to show you how I narrowed this list and how to pick stocks to put on your radar. First here, I looked to the income statement on each company for total sales and sales growth over the last few years. Important here that you're looking at sales growth beyond just last year. All the companies in that telehealth space booked amazing growth last year, but you want to find companies that are able to do it before the pandemic, as well as those that can continue to grow revenue. Now from there, I also looked at the price to sales valuation for each stock just to get an idea of how expensive shares are versus their peers in the market. So here you can take the market cap of the company, now that's the total value of the shares issued, and divide that by either last year's sales or expectations for this year. But understand there is a huge difference here in the price multiples across this group. And for example, those in the software as a service segment are being priced more like growth stocks, and you're going to see price multiples of 10 to 15 times sales. By comparison, there are other segments where the price is maybe 3 times sales is about the average. Now that doesn't mean that the cheaper stocks are always going to be the best returns though. It just means that you need to compare price multiples for similar companies. You also need to look at some of these other fundamentals like the sales growth and the profit margins just to get a good sense of which stocks are valued correctly and which to buy. Finally here, I looked through the recent investor presentations and other research to find those companies with a competitive advantage or an innovative idea. This is a little more subjective and takes a lot more digging versus just comparing those price fundamentals, but this is really where you get to understand a company and find the best in its group. Next here is OptimizeRx Core, ticker OPRX, another medical technology company in the pharmaceutical space. OptimizeRx is the nation's largest point-of-care communications platform with features in symptoms diagnosis, treatment selection, prescriptions, and patient support. Basically, the platform helps doctors prescribe the right medications and make sure the patients are taking them, which is kind of a goldmine for the pharmaceutical clients of the company. Revenue has grown at a 52% annualized pace over the last decade, with $58 million expected this year and $78 million in 2022. Now that does make it the most expensive on our list though, at 14.6 times on a price to sales basis, but in line with peers, and that addressable market is giant here. Over $20 billion is spent by pharmaceutical makers in annual marketing to providers each year, with just $4 billion of that in digital. OptimizeRx has a strong platform that can take market share in the existing $4 billion and expand it out into that other $16 billion as well. Analysts have an average price target of $50 a share here, which is close to the current price, but I think this one can surprise higher as it builds back to that $62 peak and beyond. Change Healthcare, ticker CHNG, is by far the largest telemedicine stock on our list at $7.3 billion market cap. The company is really an end-to-end technology-driven solutions provider in software and analytics, network solutions, and communications, reaching over 6,000 hospitals and 1 million physicians. The platform touches everything from payment services, risk management, and revenue cycle management, and serves payers as well as providers. Sales are expected 19% higher this year to $3.4 billion, so a little slower sales growth, obviously on that huge base, but the shares only trade here at 2.1 times on that price multiple, so the least expensive on our list. What I really like about the company though, and I don't think this is priced into the shares, is some of the innovation that it's building into the platform. It's using artificial intelligence to drive telemedicine imaging. The company is also rolling out its integrated e-commerce solution to reach the patient side of the market, and an opportunity I think could be even larger than that core business. There is a lot here between the company's data analytics and the health information program that can make this a growth stock and drive that valuation higher. Click on the video to the right for the 5 artificial intelligence stocks I'm buying right now. 5 stocks to protect your future. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.